Hi, a very good morning. You're watching Trading Hour on CNBC TV 18. I'm Ekta Patra and with me is Prashant Nair. Well, it's turning out to be a complete risk-off globally and we seem to be a part of that risk-off. So we've seen the Nifty slip below 10,100 on an intraday basis. So there is some amount of a pullback right now, but just very, very feeble at this point in time. So that seems to be the update on the market. We have a lot of earnings to reckon with. So before I get to Prashant, let's just cut across to the management of Syngene right now.
Second quarter and half-year results for FY19. Let me start my address by giving you an overview of the quarterly financials, and then I'll follow that with some of the operational updates for the quarter. So, starting with 2Q performance, I'm happy to report that Syngene registered 24% growth in revenue during the second quarter, and that took our reported revenue from 352 crore rupees in the same quarter last year to 437 crore rupees this quarter. Overall growth in the business was well balanced, with both the small molecule discovery services business and also our dedicated centres showing good traction. As you'll recall, over the last few quarters we've announced the renewals of our ongoing collaborations with BMS and with Baxter, and these are now beginning to reflect, I think, in growth within the business. Turning now and taking a look at profitability, EBITDA for the quarter was up 12% to 145 crore rupees, compared to 130 crore last year. And reported PAT, profit after tax, for the quarter was marginally up at 1% to 78 crore, and that compared to 77 crore in the last quarter.
Okay, so we'll have more on Syngene, and we'll have an interaction a little later, one-on-one, where we'll get some more details. But back to the market, which is the big story, the only story actually. I mean, talk about markets being moody and how. Absolutely, a divergent behavior from one extreme to the other extreme. Although for most parts now, for the last many weeks now, it's only been extreme to the downside. Yesterday, for a very brief period, especially in the last 30-40 minutes, we did see some buoyancy coming through. It was evident in volumes, it was evident in the kind of stocks which rallied, etc. But then you had that big sell-off overnight as far as the US market is concerned. I mean, the US indices, the S&P especially, is poised at extremely pivotal levels. And I think, you might, and we've had various opinions since the morning, and most of it has been on the lines of saying that the US market still remains remains attractive, maybe overvalued, but growth will be supportive, etc., etc. But I don't think you can take away from the fact that there has been significant price damage, and it does spoil the sentiment and confidence, etc., which we had pretty rock solid, even though the market here was suffering. And I think very broadly, there has to be a trigger in the US for markets to start to perform once again. And even actually beyond triggers in terms of news flow or corporate earnings or what might come through, it's a price performance itself which will, I think, signal to market participants that it's safe to come back into the market in size. So I think levels are important. There has been price damage. One has to take cognizance of that and watch the weekly close on those indices very closely. That is tomorrow, and how markets close there. So for now, it's basically following what the US is doing, and it's once again on the downside. 10,110 is where the Nifty is at this point in time. 1.25 lower. Sudarshan Sukhani of S2 Analytics is with us. Sudarshan, morning. Thanks very much. So any trade here now, or what? What would you do?
Yeah, good morning. See, we are at a point where the Nifty is either going to find support or breakdown. That's the 10,100 zone. I think of it as a zone rather than a number. So maybe somewhere between 10,000 and 10,100 is a band which should either hold, and the Nifty repeatedly comes here, finds some kind of support, even though the support is minor, but it still finds it, and then tries to rally. So far as this support is holding, I do not think there is any trade here. The trade will come if 10,000 breaks on the downside, then it opens up a very wide short trade, or if the support holds, then perhaps inch by inch the markets may try to make an effort to go higher, whatever little points they gain up. So at this point, we should not trade. We must let the market tell us which direction it wants to take. As you talked about the S&P, so the Nifty is also at a critical juncture, and it may take its own time making a decision.
Okay. All right. Well, Sudarshan, what would your picks be at this point?
Well, fortunately, some stocks keep on doing some activity, so we can always trade in stocks. Oro Pharma is a buying opportunity. I have been upbeat on pharma, and pharma has been outperforming. So traders should not, or investors, both of them should not start thinking that they have to exit the market. All we are doing is to say we'll watch how the Nifty behaves and then follow the market as it does, follow the Nifty. But stocks can behave well even otherwise. So consider buying pharma companies on these dips. Today is Oro Pharma. There are two short selling opportunities for the day, intraday. One is Tata Motors. I've been downbeat on this stock, and I think there is still more downside here, a significant downside left. And that's a short sell. And the other short sell for an intraday trade is ICICI Prudential. Do not carry ICICI Prudential overnight, although you could carry Tata Motors.
Okay. All right, Sudarshan. Thanks very much for bringing us all of those strategies. Well, let's get in some more F&O calls. We have CA Rudramurthy joining in of Vachna Investments. Rudramurthy, if you could start by just giving us your picks and your index call.
See, first the word on index for me, both Nifty, Bank Nifty looks very weak positionally. However, intraday shorts, whatever we had, we have covered already at 24,750 on Bank Nifty future, as well as Nifty, we covered it around 10,100 zones. Intraday, I'm not sure, we might expect a short covering bounce because of expiry, but positionally this market is very weak. The back of this market is clearly broken. Every rise has to be used as selling opportunity. Even if crude has come down from $85 to $75, you are not seeing any up move in our market. This clearly tells me we are very weak and every rise has to be used as selling opportunity. Stock specific, I'm selling India Bull Housing Finance. This stock is in a clear downtrend and I'm selling it on every rise. India Bull Housing Finance can be shorted. Look at targets of 660 with a stop loss of 705. And I have a second clear sell call on Bajaj Auto. Yesterday it has broken crucial support zones. Additional open interest with stock price moving downside signals a very weak scenario for Bajaj Auto. One can sell Bajaj Auto for next month contract. Look at targets of 2,375 with a stop loss of 2,470. And just to hedge my portfolio, I'm having one buy call. Manappuram looks very strong to me. Supports are seen at zones closer to 65 to 67. So I'm going long on Manappuram, keeping a strict stop loss of 65 to 67 on closing basis and having a target of 85 for the long call.
Okay. All right, Rudramurthy, we're going to leave it on that note. Thanks very much for joining in and taking us through all of those F&O calls. Well, for the Nifty, 10,104 is where we're at. So Sensex also weak, down around 400 odd points. Need to take a break, but before that, on a quick programming reminder, CNBC TV 18 has launched a special initiative in partnership with the National Stock Exchange. On the 25th of every month, we will tell you how investing in stock markets or equities makes one financially disciplined. The CNBC TV 18 NSE Prosperity Day is a monthly program to inform and educate investors about smart investing and enabling the journey to wealth creation. Catch our special coverage all through the day only on CNBC TV 18.
Okay, so 120 lower still on the Nifty, no signs of any let up. Varun Beverage's numbers at the bottom of your screen. Profits are up a strong 31% at 44 crores compared to 34 crores same quarter last year. Stock's not reacting, it's a down market, and earnings will matter maybe at the margin, and of course if they're exceptional. The numbers though on Varun do look pretty strong. We'll take a very quick break here. We come back, we discuss what's happening in the commodity space. We have a guest joining us from Societe Generale, and we talk commodities, oil and other things with him in just a bit. Okay, still down 120. Manisha is here with a quick roundup of all that's happening in commodities and currencies. Manisha, morning.
Prashant, thank you so much for that. As we are into the last week of October, it has been quite a month with the crude oil prices down 10%, and gold clearly is closing this month on much higher side. But let's get in Mark Keenan of Society General, who joins us to talk about that space right now. Mark, hi, pleasure to have you as always. Starting with the crude oil prices first, how would you read the turn of events where we have seen such a sharp correction come in for the crude oil prices, and what's your sense going forward?
Hi, Manisha. Yes, it's been a very big move of late. I think the two things that have changed really over the last month. Number one, commodity markets in general, and specifically crude oil, have become very macro-driven, and the weakness in global equity markets has translated into a wide risk-off sentiment across risky assets, and crude has been one of the markets that has been sold as a function of that. On the fundamental side, the only thing that's really changed over the last few months of late has been some concern about the demand outlook for crude oil. Previously, people have been very much focused on the supply side and the bottlenecks that people have been talking about on the shale side and the issues with the Iranian sanctions, and prices have been very supported because of that. So the weakness now is a function of these two nascent but emerging dynamics, and our view is that we move higher from here. Much of this weakness is macro-driven, as I said, and we see crude, Brent specifically, up to about $82, $83 for Q4 of this year.
All right. Since you are expecting the crude oil prices to come back to 80 and plus kind of levels, what is the range that you're working with for rest of 2018 and for much of 2019 as well?
Well, the interesting thing is that our risk outlook is particularly interesting. We have about a 20% probability that we could move as much as $15 higher from where we are now. And that's really a function of how the market takes the implementation of the Iranian sanctions that are starting in early November. And if there's any extra compliance to that, we expect about 1.7 million barrels to be lost. But anything more than that will be taken very bullishly. Concerns about whether OPEC, specifically Saudi, can make up spare capacity. There's been a lot of concern about that. And then, of course, any worsening of the supply outlook from the US, where previously we'd always been in an environment where shale oil was always there to make up any extra supply as needed and put a cap on prices. Now we've been in a period where we actually can't get the shale oil out of the Permian Basin because of bottlenecks in pipelines. Sure. They're due to be completed in the second half of 2019. So if we get any worsening of that situation, and if we get these risk factors converging, we could see a short-term spike, $15 higher up into the end of this year and beginning of next year.
Mark, one thing that really seems to have turned around yet again, and that really comes in from the precious metal prices, where gold is trading at a 3-month highs in the global markets. Are you advising accumulation for that now?
Well, gold has been particularly interesting because certainly the move up recently has been very significant. It's been about 5–6% since the August lows, about 4% month to date. A large proportion of that has been short covering. We had about $5 billion of shorts coming out of the market last week. And in fact, last week was the greatest in terms of futures contracts amount of short covering ever in the history of the market. So that's interesting for one, but it's also quite interesting with respect to how we move forward, because it means that we still have extra capacity on the long side for long speculators to add length. And we see gold higher between now and the end of the year, a little bit up to 1,250, a little bit higher in January up to 1,275. But we really need to see how the safe haven appeal that's clearly taking hold at the moment, how persistent that is, and how people accumulate also the ETF holdings. We've had about 1 million ounces of that over the last 2 or 3 weeks. So far the signs are good. It certainly stands in very stark contrast to how gold behaved in February, when we had a similar sell-off in equity markets and gold fell 2%. So this particular sell-off, this particular weakness seems to have been translated into a much more concrete, solid, safe haven demand for gold.
Okay, all right, Manisha as well as Mark, thanks very much for joining in and talking to us. But just want to turn back to the markets because now we've decisively slipped below 10,100 again. In fact, at the day's low for the Nifty, 10,091, 10,093 odd is where we had gone. So we've extended our losses at the low point of the day, down around 1.3%. Remember, these are the levels that we haven't seen all the way back since March of 2018. So this is definitely a multi-month low that we're dealing with. And just to put things into perspective and not to cause any sort of fear, but just in terms of levels, the 52-week low for the Nifty stands between that range of around 99.50, 99.60, which we had hit at that point in time as well. Just want to point out in terms of stocks within the Nifty space, there are just a clutch of stocks which are managing to actually hold up in the green now. So around only 6 stocks which are managing to just about keep their head above the water. Wipro continues to be a top gainer on the Nifty, up around 1.3%, but a whole host of losers at this point in time. Take a break, but be back with more opinion and stocks.
Okay, welcome back. So 130 points lower, 10,091 is where we are at on the index. Well, CNBC TV 18 has launched a special initiative in partnership with the National Stock Exchange. On the 25th of every month, we tell you how investing in markets or equities makes one financially disciplined. I mean, you also have to be disciplined in the first place to be in the market and make money. As we celebrate the CNBC TV 18 NSE Prosperity Day, we have Nigel with us to take us through the big wealth creators over the past few years. It might seem a bit of an odd day to put out this data, but remember, from the depths of despair, usually are sown the seeds for future opportunity. Nigel is here with the data. Nigel, over to you.
Well, that's right, Prashant. You know, sometimes the adverse situations throw up the best opportunities, and we're just looking at Prosperity Day. And if you compare the Nifty's move and, in fact, you know, the other asset classes, well, on a compounded annual growth rate basis or, you know, on a yearly basis, it's definitely outperformed the other couple of asset classes. So gold is up nearly around 8%. Gold, LME gold, that's in dollar denominated, that's up nearly around 3%. But the Nifty has outperformed that. Keep in mind, the real estate market as well hasn't moved much in the last few years. So if we're comparing these asset classes over the last decade or so, definitely the Nifty has given you good returns. But some of those stocks, you know, we're talking about some of those smaller names that have been big multi-baggers. Some of those large companies as well, they have given you big returns over the last 5 years or so. Bajaj Finance, that's up more than 1,500%. You have other stocks as well in there. And Eicher Motors, after already having a good run, but in the last few years, it's given you 450% returns. And so everyone's talking about the financial space, some of these home lenders as well. They have, you know, seen a big correction from the top. But some of them, they featured in this list over the last few years. And, you know, the stock move is one thing, but you're also looking at the profitability as well as the revenues. And over the last 3 years or so, many of those stocks are in there. You have JSW Steel in terms of their profit growth of around 50%. Bajaj Finance as well makes the cut. And even Maruti, the stock has corrected recently, but otherwise, in terms of a profitability growth, that's done fairly well. Not just the profit number, you're looking at the top line growth. You want to see, you know, more amount of growth on that front. And those numbers as well, up for you on the screen, some of them give you a good 20 to around a 50% return. So all's not lost. We have a lot of headwinds that we talk about, but otherwise, on a longer duration of time, Prosperity Day, that is it. Back to you.
Okay, Nigel, thanks very much. Interesting data for sure. We'll, of course, have more later on through the course of the day. Well, back to the market here and now, 130 points lower. 10,097 is where we're at. I mean, if anything, the last couple of days has shown us, I mean, one thing for sure, extremely difficult to trade this market on a directional kind of a basis with all these ups and downs and big ones at that. Ashwini is here, as always, on the top of 11:30 to tell us what he's making of things. Ashwini, good morning. Your assessment of the damage and where we go from here.
Well, it's been tough to trade directionally because there has been no direction. Now the issue is that we are now pushing on the downside in terms of a range breakdown. So where 10,100, 150 was acting as some sort of a support, now that's kind of giving way. So maybe that range-bound conditions may not last for too long, and the market is getting into a directional kind of frame of mind. Since you look at S&P 500, etc. What's happening there is that the double top is getting closer and closer to being confirmed. As soon as S&P 500 breaks 2575 to about 2600, that could happen. For me, bigger issue is that now everything is beginning to fall. So crude, equity markets, and the way we have responded to the fall in crude, it basically means that that is a non-issue, and this is about rates and liquidity, etc. This is not about one small thing getting fixed and the markets go back. So more and more we are pushing on the downside. On every good news, whenever you have a gap, you kind of selling off. So that way, it's a low participation market, and these markets can be volatile on both sides because the impact cost is so large. But overall, I would not take this correction very lightly because now it's almost 20%. It's across the board, across commodity, currencies, stocks. So that way, possibly fresh downside may be opening up. Having said that, Motherson is a sell with a stop of 235, target of 220. India Bulls Housing is a sell with a stop of 692, target of 660. And Bata is a buy with a stop of 898, target of 920.
Okay, so you'd watch levels on a closing basis today, Ashwini. I mean, how do things change if we see for some reason a sharp pullback at some point today, and then the picture changes again, or no? We have a direction now.
See, the picture does not change with these 40-50 point rallies. The picture will change. For example, Bank Nifty most recent top is about 25,400. If we start getting past those levels, you have, almost the last 6 days, you had those 300-400 point gaps on apparently good news. All of them got sold into. So there are sellers which are very strong, waiting for any rally to sell into. They have global support with them. All kinds of, problems are there domestically also. So, bears are fairly strong, and the bulls cannot engineer even a 200 point bounce back. Now, at some point, pullback will happen, but for the moment, we are hanging around more closer to 10,100 than 10,700. So that by itself shows that what kind of pressure we are in. And now global indices are falling. In case they also start to fall below, say key levels of about 2,600 thereabouts, then trouble will start to mount because it's very unusual to find a 10% correction on large global indices, and that's happening day on day.
Ashwini, financials still remain the most vulnerable part of the market?
See, the debate here is that is this a global slowdown? Now, if it's a global slowdown, financials have much more lower to go. You heard about what's happening to our consumption. Because if this is about liquidity, then liquidity is going to tank all stocks, all risk assets. This is a global risk off. If it is, then I think there is more downside. I think domestic issues may not be even relevant because why would crude fall? We are talking about this Iran sanction. Iran sanctions have actually collapsed crude. So what are we talking about?
Yeah. Well, confounding kind of signals. What is the cause? What is the effect? It all seems backward sometimes. Ashwini, thanks very much. Appreciate you joining in and running us through your trades and the broad assessment of things. We're going to take a very quick break here. We come back and we will speak with Swati Kulkarni, Executive Vice President and Fund Manager at UTI Mutual Fund. That conversation comes up. All right, 115 points lower, 10,110, and this is a pretty red screen all over the place. Just to take a very quick look at what's happening as far as sectoral indices are concerned. The top loser is the real estate space, is down 2.6%. The PSU Bank Index follows with a 2% cut, and then we have the metal index, which is down 1.9. A small cap index, media, auto, energy, all in the 1.5. Mid cap index, all in the 1.5% loss range. I don't think there's a single index which is higher. Well, cannot be. So yeah, I mean, absolutely nothing which is higher at this point in time. Just want to take a very quick look at what's happening across the board as far as stocks are concerned. There's visuals coming in. Ravi Shankar Prasad is sort of addressing the gathering at the India Mobile Congress, and we have other senior people there who are going to speak, and we'll cut to those some of that sort of speech in a bit from now. Okay, Swati Kulkarni is with us as well, I'm being told, Executive Vice President and Fund Manager at UTI Mutual Fund. Swati, thank you for your time, appreciate it. So, what is your assessment? I mean, it was all local, globally things were fine. Now there is a global slump with the US equity sell-off that is putting further pressure. It's all waters have been muddied quite significantly. Your assessment?
Yeah, good morning, Prashant. Yeah, as you rightly said, first I think it was the fragility which came up in terms of oil prices going up and its effect on the current account deficit, the fiscal constraint and its impact on the rupee. And of course, global tensions were also there in terms of the trade wars and also the kind of sell-off that we have seen in globally in recent times. The tightening that is happening and the interest rates going up in US, so there was a natural move towards dollar-based assets. So all this, I think we can't really time perfectly when it will come, but if you remember, we have been raising these issues repeatedly on the volatility, and I think those things are playing out now. In addition to this, we have our own problem of now risk aversion setting up after the ILFS issue and the NBFC related liquidity crisis that is feared. So I guess these things can come up, and then therefore what is important is how you protect or how you prepare as far as your portfolio construction is concerned, and therefore the importance of process again comes up.
Swati, before we discuss some of these things and what you are doing right now, the month of October is almost done. Just to give us a sense, is the equity flow into funds, I mean your fund for example, at the same levels as what we saw in September?
Yeah, so fortunately actually the flows as such have been not that much affected, but yeah, there are some people are taking profits in some of the investments which are now like more than 1 year or so. So I think that is business as usual. We are not seeing any noticeable trend as far as my funds are concerned.
So one could talk. I mean, so one could say that for the aggregate picture as well, right? I mean, there is no. It should be okay. Flows, right? In October.
See, what happens is, I think the pressure is more on the debt and liquid fund side, I guess, and that also was more in September end, and that seems to have sort of normalized in the first fortnight of October. But yeah, I guess the pressure was more on that side because of the concerns of what NBFC's portfolios are holding.
Okay, fair enough. Now that with that clear out of the way, just to get a sense, you outlined everything which is in the backdrop causing this, but as a fund manager, how are you reacting to it? Are you creating a little bit of cash? Have you already done that? You're still waiting, or this is already time for you to go and buy? What are you doing?
So Prashant, actually through the correction we have been buying the stocks which we are convinced about their long-term sustainable cash flows and the kind of their profitability is concerned and the return on capital is concerned. Wherever we are comfortable that the business models are sound and they will have the power to navigate through these volatile periods, we are confident of buying such names. As far as the cash is concerned, we are not really looking at fact, managing the risk by raising cash levels. I think almost all our portfolios are 95% up invested into equities, because that's the mandate that we have taken, and investors also would have done asset allocation based on the assumption or the promise that we would invest that money which is coming into equities back again. So I think we are managing risk by, as I said, that what is the kind of portfolio which is allocated into high return on capital employed. So most of our products are, in terms of cash flow, more than 75% of our investments are into firms which have been generating sustainable operating cash flows for last 5 years. So that gives a kind of ability of the companies improves to sell through this liquidity crisis, for example. And so I think that is what, and again sectoral allocation will be based on which are the sectors where we think that things could start improving, or already they are agnostic to the macro problems. That is how the each and every portfolios would get built up.
Okay, Swati, we'll leave it there. Appreciate you joining in. Quick conversation today, but important to get a sense from
Thank you,
a person like you and a fund like yourself. So appreciate it. Okay, so that is the UTI mutual fund view, which is coming through at this point in time. 106 points lower, so we are about 15-20 points off the recent lows that we saw in the last 1 hour or so. So some pullback. We'll see if it lasts at all or gets sold into. We take a very quick break. We come back and we have the L&T Infotech management, which will join us. The numbers for the second quarter were good. Sanjay Jalona, Managing Director of the company, speaks in the same. Back in 2.
Welcome back. Well, it seems as though BHEL has come in much earlier than what it generally used to come in at. So revenue is come in at 6,780 odd crores. This is below our poll of 6,995 odd crores, and the net profit has also come below our expectations. So 185.2 crores versus an expectation of around 258 odd crores is where the bottom line has come in. Remember that it's been a tough couple of quarters when it has really come to the bottom line of BHEL, but this time round also maybe just a marginal miss into around 100 crore, less than 100 crore miss in terms of the bottom line is what BHEL has reported. Revenue too has been a miss, so we're waiting by for the margins, and in fact the stock is reacting negatively to the numbers, down 2.5%. We have Anisha joining in to just give us a sense in terms of what the other numbers are and the prima facie sense on the top line and bottom line. Anisha?
Well, it looks like it is a miss. A couple of numbers that we have. In terms of the top line, it does not look like it's a big miss, but nonetheless, the street would not take it well, given the fact the weakness that we have seen in the stock. Remember, it was trading at a level of 120 earlier. Now it's seen at a level of 75. There were a couple of brokerage upgrades that we had got. They said that maybe things will turn around from this quarter onwards, because in the last quarter as well, the company was able to improve their operational performance and the margin performance was better, but that does not look that it has come by this time. I will just go through the internals.
Margins have come in at 3.5% versus a poll of 6%. So it's around a 250 basis points miss in terms of the
So
margins.
that's a definite miss, because last time what had happened was the margins were better than expectation, and the street was waiting by to figure out whether those can be sustained or not. And the number of 3.5% will definitely not go down well. Yes, there were margin pressures. There was the rupee impact as well that was expected to maybe impact the numbers a tad bit, but 3.5% would not go down well. The other income for the company has also gone down, and that's the reason you are seeing that profit, miss as well. A part of it was expected because the company's cash balance had gone down, but I think margin will be the main talking point.
Okay, and we had the segment revenue as well. So the power revenue has been just about marginally higher year on year. So 5,153 as compared to 5,064 crores year on year. But it is the industry segment which has also actually managed to grow. So 1453 odd crores versus 1103 crores in terms of what they've reported on a year-on-year basis. We do have a reaction coming in, and we'll get to the segment EBITDA as well. Just before that, the power EBIT has come in at around 425.7 crores compared to 669 crores year on year, and it's lower Q on Q as well. Industry EBIT is at around 69.6 crores, improved dramatically from around 1.78 crores, Anisha.
Well, yes. So in terms of segments, as we mentioned, that was expected that the industry segment would actually perform much better than power. We have been seeing the trend play out. But the disappointment seems to be in terms of the power bid, because that has fallen quite a bit, because it's come in at a much lower level than what we expected. So that seems to be the worrying point, because other than that, when I was looking through the internals, the employee cost has not gone up too much, because that is one of the things that we watch out for when it comes to BHEL. The cost of consumers has actually gone up. So it looks like it's a gross margin miss coming in from the company this time around. The other expenses are also steady. So it does not look like there is a one-time provision or anything of that sort. Yes, sequentially, the other expenses have gone up 200 crore rupees. So we'll have to see if there's any one-off, because that is what BHEL does usually. I was going through the other notes. They have not disclosed their order book in the notes to account, which they usually do. And in terms of the balance sheet, the key number to watch out for is receivable, and they have gone up further. Now, this will not go down well. One of the major problems with BHEL has been the fact that the receivables have been mounting, and the management has been coming out and clarifying every time that they're working on to bring down the receivables. As of September, the receivables are at 18,700 odd crores versus 14,700 that they had in the month of March. So that clearly is another pain point.
Okay, well, we have Rabindra Nath Nayak, Senior Analyst at Sunidhi Securities, who's with us now. Rabindra, what's the key disappointment according to you? The margins?
The margin is the clear disappointment. We're expecting around 5% margin, and company reported 3.5% margin. So there is a clear disappointment. Largely, the power segment is actually disappointed.
Rabindra, do you expect that this is on account of some one-off, or do you see that the gross margins have come off and that is a bit of problem? And does that raise question on the sustenance of margin overall?
Expected, where raw material prices might have spiked. That's one of the reasons could be the margin has come down. So 3% QOQ last quarter 3%, it has come down to 3% again. People are expecting, and we are expecting 5% margin, which is clear disappointment.
Okay, I think we have Renu Bed also joining in. Renu, your first reaction to the numbers? Of course, the margins look a tad bit of miss, and even the receivables have gone up.
Yeah, I would say the disappointment essentially is also flowing in from lower revenues. I think execution run rate has been a bit softer. We were expecting almost 10% growth and reported 6% YOY growth. What I would say on the gross margin side, if one has to read through the fine prints, then clearly gross margins have improved on a YOY basis by about 125 basis points. On a QOQ, we were expecting moderation. So clearly, at least on gross margins, numbers are better than our estimates. Where we see in terms of numbers, the other expenses were also higher. So probably that would be partially because of higher provisions, which they have at the end of the quarter in terms of the net provisions which they make through. And also, so I think at the operating level, definitely, yes, I think it is partially to be blamed to the negative operating leverage, or the positive delta was not to the extent expected. Otherwise, on gross margin, I think numbers were fine, but yeah, the lower top line has resulted in lower EBITDA for them, which is why EBITDA is at 240 odd crores.
Okay, and Renu, we had seen a couple of upgrades come in for the stock, factoring in maybe higher order inflows going forward, as well as factoring in the fact that maybe the performance will become stable from now on. Do you think this will further raise questions on the, variance in terms of the performance that company has been showing, as well as what are your expectations in terms of order inflow this quarter? We don't have that number as yet.
For this quarter, my order inflow numbers are approximately 3,750 crores. They had received FGD orders also this quarter. But I think for the on an annualized basis, inflows in the power space should be close to 25,000 crores for them. They're already L1 on 20,000 crores worth of BTG and power equipment orders with them. So I think inflows-wise, they will be able to broadly, as in on a YOY basis, it would be a drop, but they will try and catch up. I would not worry too much on the execution front from financial year 19-20 perspective, because today they have a reasonably better executable backlog compared to a year back. So the executable backlog is up almost 60% compared to last year. Power sector was almost 86,000 crores at the end of the previous quarter. Slow-moving orders have narrowed down. And some of these orders which they have received from Bangladesh, Metri, you have the southern states, Telangana and UP orders coming through. They will translate to numbers in the next, I would say, 1.5 to 2 years. So I think from an execution perspective, it would be more of a timing issue in my view. But the broad concern on the power sector still remains that, on an annualized basis, you're not seeing the market being more than 5-7 gigawatts. So this year only 2 projects have been finalized. So barely any orders in the pipeline.
All right, Renu, thanks very much. Appreciate you bringing some perspective to the numbers. Ravindra, appreciate you joining in as well. Anisha, thanks for taking us through the BHEL Q2. Stocks down 3%. We're taking a very quick break here. We'll come back. Market is down 93, so there is a full 40-point bounce from the lows that we've seen in the last, 15 minutes or so. We come back, more on the other side.
Back. Well, it's a lot about the financials today. So L&T Finance Holdings down 7.5%, DHFL down 6.7%, and Indiabulls Housing Finance making headway down, so down around 6% for that stock, 697 rupees in fact for that stock. But Yes Bank is also going to be releasing numbers this afternoon. We have Abhishek joining in to tell us what we can expect. Abhishek, there was a call held by the management during the quarter in any case, or just a couple of weeks ago. So we got a sense in terms of what this quarter could contain.
As you mentioned, Ekta, the loan growth that they mentioned in the press release was that the loan growth is at 61.5% on a YY basis, and this is the strongest ever loan growth that I have seen in Yes Bank over the last 3 to 4 years. They've also mentioned that gross NPA will be at 1.35% versus 1.31% in the previous quarter. But the highlight of the results will be in terms of the net interest margin. That has been on a declining trend due to the fact that cost of funds have risen for them, and they are a big player in the bond market. So arresting the fall or decline in net interest margin will be very positive. Anything at and above 3.2% in terms of the net interest margin will be positive. Provisions can remain elevated due to the fact that mark-to-market treasury losses are there. Slippages also can remain elevated as per analysts like Philip Capital are working with a slippage number of close to 700 odd crores versus 500 crore in the previous quarter. However, recovery in key accounts from the NCLT can lead to a push or substantial improvement in gross NPA. So asset quality largely at 1.35 versus 1.31 is what the management has already mentioned. NII is expected to grow at 28% while net profit at 25%. Back to you.
Okay, I think extremely interesting set of results, and the press conference will be important to track as well. That's at 3 o'clock this afternoon. We take a very quick break here from Ekta, me, everyone on the team. Thanks very much for watching. Halftime report is coming right up.